Welcome to this month's edition of Up to Speed, Baker Tilly's Automotive Industry Podcast. I am your host, Mike.mader, the dealership industry leader for Baker Tilly. On a monthly basis, Up to Speed serves as the automotive industry's connecting point to hear about conversations from industry leaders regarding topics that pertain to tax, accounting, and operations of retail dealerships. We typically arrive in your mailbox the third Wednesday of every month. If you would like to listen or view some of our past episodes, you can find them at www.bakertilly.com/dealerships. Also, if you do have a topic that you are interested in, want us to do some additional insight on, please let us know by reaching out to us on our website. Our goal is to provide you with relevant, up-to-date information that is quick and easy to digest that you can watch or listen to on the go. Our discussion topic today is going to be on reinsurance. Reinsurance can be very lucrative to dealers, but they need to know some of the basics as it can also become complicated and expensive if it is set up or not managed incorrectly. My guest with me today is Mark Baran of GPW and Associates. Mark is a director at GPW and Associates, has a CPA, and is also an attorney. Mark's area of specialization includes captive insurance and F&I service contract programs. He provides consulting on areas such as DOWCs, or dealer-owned warranty companies, controlled foreign corporations, CFCs, and NCFCs, non-controlled foreign corporations. Although Mark is an attorney, we will not be discussing legal situations, and he will not be providing any legal advice today. You definitely want to consult with your CPA and attorney if you are considering setting up a reinsurance company or changing the structure of your current reinsurance company. So with that, Mark, it's great to have you here today, and welcome to this month's episode of Baker Tilly's Up to Speed.
Thank you for inviting me, Mike. I'm looking forward to engaging in this discussion with you and help your dealership clients have a better understanding of some of the issues in the dealership space.
Awesome. So, Mark, reinsurance companies have been around for quite a long time, but there seems to be a perception that makes them somewhat of a mystery in the industry. You know, there's multiple names, reinsurance companies such as, I mentioned a couple of them earlier, CFCs, NCFCs, DOWCs. I mean, we've got all these acronyms to try to figure out, and how does it work tax-wise, business-wise. So can you talk about what some of the various types of entities that are being used by dealerships to manage their reinsurance products?
Sure, thank you. You're right. There is no shortage of acronyms in this industry and any other industry that folks engage in. But to start with, there's really two types of risks that dealerships and other businesses, but I'm going to focus on dealerships. There's two types of risks that are reinsured or engaged in. The first one is third-party risk, or we might think of it as what is known colloquially in the industry as F&I risk, or risk of customer contracts that are purchased and reinsured into a reinsurance company that's owned by the dealership. And then there's first-party risks. We have a hard insurance market right now, and there's a lot of dealerships that are looking to leverage off of those third-party risks and self-insure risks of the business, which could range from healthcare, workers' comp, or property and casualty coverages that they can't get in the market, like wind and hail, or other risks like deductible reimbursement programs that they cannot deduct until they incur the expense. I'm going to focus on F&I, but there are certain risks with first-party risk that I mentioned that the folks need to be aware of. And I will, before I jump into that, I'll say it's very important. It's vital that dealerships and dealers work with their CPAs and attorneys, and also a captive manager that understands the minefields, because there are many, the minefields in this area. It's not an area that can be dived into without understanding the full playing field and understand the risks.
So let's I might shift your speed here, but let's talk about that first party risk. That's, sure. You know, typically in the dealership area, we see that third party risk dealing with extended service contracts, gap insurance, different things like that. This first party risk, that's more risky. And there's a lot of things. That's why the IRS came out with what, in our viewpoint, the IRS came out with the 8666 was more for this first party risk. So can you talk a little bit about the risk on some of that stuff?
Sure. And what happened was the first party risk, and you're thinking of the Form 8886, the IRS is concerned about abuses in reinsurance and insurance. And unfortunately, dealerships and the F&I industry have kind of been the dolphin in the tuna net, being caught up in a lot of this scrutiny by the IRS.
Mm-hmm.
And there were proposed regs that were issued in April of 2023 after the IRS lost court cases in the Sixth Federal Circuit in Tennessee. It went up to the Supreme Court, but the IRS ended up losing, and the court found that the Notice 2016-66 that required that Form 8886 reporting, which is reporting a transaction of interest, the court found that that was not a valid notice because the IRS failed and Treasury failed to meet the requirements under the Administrative Procedure Act. Those same reporting requirements do apply to dealerships, and in fact, Mike, the proposed regs that are issued, which I can talk about a little later in the discussion, include a carve-out exception for dealerships that meet certain definitions. Now, there's a lot of controversy in the industry with folks about those exceptions and their way they're written with loss ratios, and there's still a reporting requirement. But needless to say, you are right. First-party risk is something that needs very careful attention and needs to be carefully considered with your business advisor, including CPAs and attorneys.
And I always think of that third party or that first party risk is a dealer in Canada, in the middle of Canada, writes insurance for a hurricane. I mean, what are the chances that it's that abusive side that I think the IRS was going after, as you had mentioned?
That's right. In fact, the case that people may not be aware of, there's a case called Abrahami out there that started a lot of this discussion, and it was similar to what you're saying, except they were writing earthquake risk or terrorist risk in Phoenix, Arizona, and in the court, it didn't pass the laugh test. And this is one facet of the case where there were bad facts. And that's the key, is when you understand the rules and the law, just like when you're watching a sports game, you understand how to behave properly. And unfortunately, there's a lot of bad actors, and there has been bad actors in the insurance space that sidestep these rules and don't properly advise their clients. And unfortunately, it's the clients that end up paying the price.
Right. It's the bad 20% that make it bad for the other 80.
Correct.
So, all right, why don't we talk about this third party? Tell us about some of the different programs out there, the CFCs, the NCSCs, and the DOWCs. Kind of just give us a preview or a high-level discussion of what each of those types of entities are.
Sure. So CFCs are probably the most historically known reinsurance entities, and they're loosely called CFCs, which means controlled foreign corps. And the reason they were called that is these were entities that were domesticated offshore. Not offshore for any nefarious purpose, but when you file in a state as an insurance company, you have more regulations where there's required capitalization, required audits. And what has been done over the last 40, 50 years is they were domesticated offshore in jurisdictions like Seychelles. That's not so popular anymore. Turks and Caicos. And then what happens is when it's first formed, it's a controlled foreign corporation. The taxpayer or the captive manager working with that taxpayer or the firm, they make what's called a Section 953D election. And that's an election that the entity is deemed to be a U.S. corporation and a U.S. taxpayer. So although it's really domesticated offshore, it's deemed to be a U.S. taxpayer and a C corporation for U.S. tax purposes. So a basic CFC that I'm talking about here is just an entity that is formed as an insurance company to write and reinsure certain risks, service contract risks, ancillary risks like tire and wheel, paint and fabric, various risks. And it allows the dealerships to participate in the profits of those contracts that are sold to the customers. There's typically a floor that's required to be met. So if you have a dealership that's starting out and they're not selling enough contracts, they're not going to meet that floor to justify the cost to set up that kind of a program. But once they do, it's very lucrative. You can participate not just in the profits of the contracts, but you can also receive investment income on the money that's being held to pay those claims. And when a customer purchases a contract, let's just assume it's 5 years, as those contracts earn out over the 5 years, there's money set aside to pay those claims that you earn investment income on. And then, of course, there's other strategies that other consultants provide advice on how to manage claims and control costs to be a profitable reinsurance company for those contracts. That's the starting point, CFC.
Okay.
As dealerships get larger, they can look into different areas. Another area where dealerships can utilize profit participation is through what's called a non-controlled foreign corporation, or an NCFC. And the difference there is the entity is not, it's not a U.S. It's not an entity that falls within the jurisdiction of the U.S. tax code. However, and there's always a however when you're looking at this. There are other exposures where the entity needs to be careful about, as far as the way how it is being monitored, because it could be a passive foreign investment income or passive foreign income company. A PFIC is what we call, and there's certain disclosures that need to be considered and need to be worked with your tax advisor. We typically don't see NCFCs with smaller dealerships reinsuring contracts. We also have there's also a program that's been out maybe 20, 30 years now called the DOWC, and that stands for Dealer-Owned Warranty Company. And the difference between a CFC and a dealer-owned warranty is a dealer-owned warranty company, the dealership becomes the obligor in the contract, as opposed to a CFC, where there is a contractual liability insurance provider that is actually, it's what's called a first dollar policy. And the claim is paid by that administrator, and under that contract, under a DOWC, the dealership is the obligor. The main difference is it's when you have a CFC, it's much easier to if you want to exit the program, you can do what's called a recapture with the administrating agency. But when you're a DOWC, or a dealer-owned warranty company, you're the obligor. You're carrying that risk, and you can't shut down that entity until the contracts all earn out and you're on the hook. There's still a policy covered if everything wipes out, the customer's protected, but it's a much more expensive process in the CFC. The other difference is DOWCs are required to get licensed in the states that they provide and sell these contracts to. And there are certain states, like Florida is one of them, where it's much more difficult to be licensed. You have minimum capitalization requirements. Florida law has a lot more impediments to do it. So there's different reasons why it may or may not be beneficial to be in a DOWC versus a CFC. Just like with an NCFC versus a CFC, there may be differences.
Okay, so the DOWCs, what I hear from a lot of dealers is that, they are a little reluctant to go into them, because they say, we had it, and I want to say it was back in the 80s when a couple of these reinsurance companies went under, and they got stuck holding the ball. Have you seen anything like that? It seems like they've restructured these a little bit differently to protect dealers a little more, or what are your thoughts?
Well, with DOWCs, there's an underlying contractual protection, and it's called a failure to perform clip, or an FTP clip. So just worst case scenario, the DOWC goes under, the consumer's contract is going to be covered by that failure to perform clip. That is true, though. The dealerships are the obligor in the contracts, and unless they sell that DOWC, it's going to be very difficult for them to get out of it. The bigger question, like I said, is licensing. And then I also, unfortunately, I'm still hearing some dealerships being told incorrectly that they can, as opposed to a CFC, a DOWC, any money that is paid in premium, they have access to. That's not accurate. And let me back up a second. Typically, when a dealership sells a contract to a customer, some portion of that payment, when it goes back into the reinsurance company, it's held in a restricted trust account to pay those claims, as it should, because you have to have money to pay claims. You're an insurance company. So with CFCs, the cash that's collected is typically restricted at anywhere between 102 to 120% of what the expected claims are. DOWCs, they are able to release more cash, but it doesn't mean it's not going to be 100%. It may be a smaller percentage, but I'm also hearing in the market that there are administrators that are becoming more flexible in the CFCs. That is nothing that is certain, but I anticipate that there's going to be more flexibility as the market adapts and adjusts to the DOWC structure.
Okay, so the little birdie told me something about a potential new structure that's out there called a hybrid DOWC.
Yeah.
So can you give me a little insight as to what's going on with hybrid DOWCs?
Sure. So just top level, and there's multiple administrators that are in this, and they're trademark programs. I'm not going to mention the names. I'm just going to talk about it top level as far as what we call is retail reinsurance accounting or reserve accounting. And the difference is the way that the contracts come in the insurance company contractually. So when they come in at reserve accounting, there are certain costs, and typically they're called DAC costs or deferred acquisition costs, that consists of commission costs that are paid by the administrator and they don't roll down into the reinsurance company. With these hybrid type reinsurance companies that you're alluding to, they use and they contractually use what is alluded to as the retail reinsurance accounting, where the contract comes in with those higher costs or commissions that are held back at the dealership. And the consequence under the accounting rules and the Internal Revenue Code is that those expenses are deducted when paid, and it ends up generating an upfront net operating loss. That doesn't mean that it's creating a difference or a disparity of taxable income over the contract. It's really a timing issue, Mike. So up front, there's a higher loss because the expenses are taken, but assuming that you don't write an increase in business, there's going to be more income on the back end. So if we compare retail reserve accounting versus reserve accounting, at the end of the life of the contract, the taxable income is the same in both programs. It's just a matter of timing of how the expense is taken, where retail accounting generates that loss up front that you don't really get with the reserve accounting. And that's kind of the similarly how the DOWC structures work. Same thing.
Okay, perfect. Thank you.
Sure.
So, are there any recent F&I industry updates that dealers should be aware of that are participating in their F&I reinsurance programs? It always seems like there's something out there.
There's always something in this industry. I find it personally exciting because there's always something changing, but it is important for dealers and dealerships to be aware of that and make sure they're working with folks and advisors that advise them of that. The first and the most important one that I speak on regularly and have been speaking on for the last few years was the Notice 2016-66 and what was going on there. And most recently in 2023, as I discussed earlier in our discussion, is the proposed regulations. Those were issued on April 10th of 2023, and they're proposed at that point. I emphasize the word proposed because they haven't been adopted. Now, all indications from Treasury and IRS is they're going to issue them as they've been written. However, there's been some other case law out there, which I'm not going to get into, which relates to how the courts might review regulations that are issued that may or may not impact how they come out in final form. I have no opinion whether they're going to be changed or not, or they'll come out in their final form. I don't know. But dealerships and dealers need to be aware that on the horizon, there's likely to be some change that they need to be confident that their advisors and their captive manager are going to be on top of and help them navigate and tact into that change if or when those proposed regulations are adopted in final form, which will likely include some additional reporting as a transaction of interest, even if they participate in just the third-party reinsurance of dealership contracts to customers that we've talked about. There's the second thing to be aware of that's been bubbling up even in the last few weeks, which is a very hot topic, is the Corporate Transparency Act. This was a law that was passed under the former Trump administration, and it was bipartisan. However, there were some suits in various federal jurisdictions, including one in the 11th Circuit out of Texas. And 2 weeks ago, there was a judge in the Eastern District of Texas that issued an injunction enjoining the enforcement of the Corporate Transparency Act as likely unconstitutional. However, last week, the Department of Justice filed an appeal up to the 11th Circuit from the lower court, asking that injunction be stayed. Getting out of the weeds of some of this mumbo jumbo injunction stuff, it's important to talk to your attorney, and it could include your insurance or reinsurance company if it's domesticated in the United States. Could be in the Delaware tribe, but there are requirements that you may be subject to, but it's important to make sure that you're getting the correct information and you're engaging with your advisors Corporate Transparency Act affects a lot of other entities outside of insurance and reinsurance companies. But again, I'm not here to provide any legal advice, but just to advise you and your customers or your clients to make sure that they have proper advising and guidance on some of these issues.
Okay, awesome. So, there's always something else going on. So are there anything as far as, as dealers are growing within their practice or their industry and the reinsurance companies grow, is there something that need to be ongoing that they need to be considering?
Yes, absolutely. That brings to mind a couple of things. The first one are what's called controlled groups, and that's a term of art under the Internal Revenue Code. And for anybody that's watching this as a CFO and they like the tax code, it's Section 1563. But that's basically when you have two or more entities that are commonly owned by the same shareholders, and there's a definition in there, then you're required to aggregate the premium in those two entities to determine whether you pass the test to make an 831B election. There have been many circumstances where dealerships have chosen to use trusts as shareholders, or there's not a clear understanding of those rules, and they inadvertently get into a controlled group and they blow the 831B election. And the distinction, and we didn't really talk about it a lot at the top of the discussion. Let me pause and mention it. A lot of these reinsurance companies are small reinsurance companies where they write less. Currently, it's 2.8 million in 2024. It's going to go to 2.85 million in 2025. But if they write under that threshold and they meet a series of other tests, which I'm not going to talk about in this discussion, but are important, if they meet those tests, they can make a Section 831B election. And the opportunity there, if they fit the requirements, is they only pay tax on investment income, not on the underwriting premium that is earned in that insurance company, only on the investment income. However, if they fail to meet the controlled group requirements, which is one of the landmines in this area, they end up paying tax not just on the investment income, but now they're paying tax on the underwriting income, which can be devastating and a big shock. And it's never a fun call to have with a client to share with them that they made that mistake or that happened. That's the first thing. The second issue, aside from controlled groups that I see regularly, are loans. A lot of dealers, which is fine, they use their reinsurance companies to help out with floor plans in the dealership space. It's important to emphasize, and this applies to any loan from a business that a dealer has, whether it's an insurance company or their dealership. Calling something a loan does not make it a loan. A loan is a term of art under the common law or the case law in the Internal Revenue Code, and it's a series of factors that are tested to make sure it's a loan. And I can share with you in audit defense that I've been engaged in, affiliated shareholder loans are at the top of the list for review by an audit. So what does it mean to be a real loan? There's several factors. I'm just going to touch on a few. The first one is it needs to have a market rate of interest, a reasonable rate of interest. The second one, it needs to have an agreement. Third one is it needs to be followed and serviced. If you write a loan agreement and you have a 5-year term of the loan, you don't repay it within 5 years, that can be problematic for you. Same thing is if you're not servicing the debt with interest or principal, that can be problematic. So it's important that you, like I said, the Internal Revenue Code is a playbook, and it's important to have advisors that understand these rules to help your clients navigate through these minefields. Are there mistakes made sometimes? Yeah. But hopefully through this webinar and advisors, dealers have a higher awareness of the importance of watching out for at least loans and controlled groups, which are two of the top things I see in the space.
It's interesting you bring those up because I want to say those are probably the two biggest hot topic items that we discuss with our clients in reinsurance. It's, hey, you know what? We're going to take all this money out of our reinsurance company. I'm okay. Are you taking it as a dividend? How are you doing this? Well, no, we're just going to take it as a loan. Do you have the proper terms and the agreement set up? Well, I don't know. Our administrator didn't really say anything. I said, well, yeah, you have to have those set up. And the other issue on this control group, it comes up so often.
Yeah.
Our dealers say, hey, you know what? I'm going to set up another reinsurance company. Okay, what are you doing with the old one?
That's right.
And our recommendation is always to try to start it at the beginning of the year because you avoid that entire year's worth of seeding those premiums into that reinsurance company to hit that limitation for the 831B election.
That's right.
So they want to do this stuff and go, which is all great, but it's got to be structured and planned out. Otherwise, you're going to kill these things like you just talked about, the loans and the hitting the election, the premium seating limits.
Nobody, and I like to use these sports metaphors, but nobody wants to have their team on the field constantly engaging in fouls and losing the game because the coach or the players fail to understand the vital rules. And it's not much different in business. We all have to follow certain rules. These business entities are separate and distinct from the people that own them, and their distinction must be respected,
Right.
And the rules must be followed. It's very important.
Yes. Awesome. Thanks, Mark. I appreciate it. So that concludes this month's episode of Up to Speed. So Mark, I thank you for giving us some insight, some understanding of the different types of reinsurance organizations and the things we need to keep look out for and how our dealers can apply them. So thank you very much.
Thank you for inviting me, Mike.
So to our audience, thank you for joining us today. And if you have any questions for Mark, his contact information will be displayed on the screen. Feel free to reach out to him directly. We look forward to seeing you on our next Up to Speed episode. Remember, we arrive in your mailbox the third Wednesday of every month, and you can also visit our website at www.bakertilly.com/dealerships to view any past Up to Speed episodes. Until next month, make it a great day.